A grey office tower stood in the middle of one of Europe's busiest financial districts. Thousands of people walked past it every day without giving it a second glance. There were no long lines of customers, no illuminated bank signs, no busy tellers counting cash behind reinforced glass. In fact, if you walked inside expecting to open an account, you'd probably leave confused, because the institution responsible for moving billions of dollars around the world barely looked like a bank at all. Yet behind a handful of offices, encrypted servers, legal paperwork, and a carefully constructed network of shell companies, an invisible financial machine quietly became one of the largest money laundering operations ever uncovered. No sprawling headquarters, no nationwide branches, no thousands of employees, just a ghost bank hiding in plain sight. For years, criminals, corrupt politicians, sanctioned oligarchs, organized crime syndicates, and international fraud networks all seemed to arrive at the same destination. Dirty money entered from one side of the system and emerged on the other, appearing almost completely legitimate. The bank wasn't famous because it was large. It became infamous because almost nobody realized how much money was flowing through it until investigators started following transactions that simply didn't make sense. The institution sat at the intersection of international finance, offshore secrecy, and regulatory blind spots, three ingredients that, when combined, created the perfect environment for financial invisibility. Modern banking isn't built on vaults filled with cash, it's built on trust. Every second, banks send millions of electronic messages instructing other banks to move funds across continents. Salaries, mortgages, investment portfolios, corporate acquisitions, and international trade all depend on these invisible instructions moving flawlessly between financial institutions. The system works because every participating bank assumes another institution has already completed the necessary identity checks, anti-money laundering procedures, and regulatory compliance. That assumption saves enormous amounts of time, but it also creates opportunity. If one bank quietly lowers its standards while maintaining access to the international financial system, criminals don't need to compromise hundreds of institutions. They simply need one willing gateway. During the early 2000s, several small regional banks across Eastern Europe and the Baltics found themselves in an unusual position. They weren't competing for ordinary customers, they were competing for foreign money. Opening accounts for wealthy non-residents generated enormous fees. International companies could move millions through complex corporate structures without ever visiting the country where the bank was legally registered. On paper, everything appeared perfectly legitimate. The account belonged to a corporation. The corporation had official registration documents. Every individual transaction looked ordinary. The real deception existed several layers deeper. Behind many of those companies sat nominee directors, offshore service providers, anonymous shareholders, and legal entities registered in secrecy jurisdictions thousands of kilometers away. Tracing the real owner became almost impossible. Money could pass through 4 countries before breakfast. By lunchtime, it might have crossed 6 more. Every transfer created another layer of distance between the money and its original source. Investigators later discovered enormous financial pipelines carrying funds connected to tax fraud, corruption, embezzlement, sanctions evasion, organized crime, and politically exposed individuals. None of those transactions announced themselves as criminal. They looked exactly like ordinary international business payments. Consulting fees, equipment purchases, loan repayments, import invoices, investment transfers. The paperwork was immaculate. The reality behind it often wasn't. One particularly sophisticated laundering strategy became known as mirror transactions. Money entered one jurisdiction in one currency, while an equivalent amount quietly exited another jurisdiction in a different currency through seemingly unrelated corporate entities. To regulators examining individual transactions, nothing appeared unusual. But viewed together, billions of dollars were effectively being relocated without attracting immediate suspicion. The machine relied less on hacking banks than on exploiting the assumptions banks already made about each other. Compliance departments became overwhelmed. Millions of legitimate transactions flowed every day. Finding one suspicious payment inside that ocean of financial activity became like searching for a single grain of sand on an entire beach. Some warning signs appeared. Compliance officers filed suspicious activity reports. Correspondent banks asked difficult questions. Journalists noticed recurring company names appearing in international investigations. But the machine continued operating. Each institution only saw its own small piece of a much larger puzzle. No one had the complete picture. Until investigators from multiple countries began comparing financial records. What initially looked like isolated fraud cases slowly merged into one enormous network stretching across dozens of jurisdictions. The same shell companies appeared repeatedly. The same intermediaries surfaced again and again. The same banking channels processed extraordinary volumes of money for businesses with little obvious commercial activity. Investigators weren't chasing one criminal organization anymore. They were mapping an entire financial ecosystem. As international cooperation increased, regulators introduced stricter customer identification requirements, beneficial ownership registers, enhanced due diligence procedures, and far more aggressive monitoring of cross-border payments. Banks invested billions into compliance technology, powered by artificial intelligence capable of identifying unusual transaction patterns that human analysts would never notice. Large international financial institutions also became far more cautious about maintaining corresponding banking relationships with smaller foreign banks whose compliance standards appeared uncertain. The cost of weak oversight had become painfully clear. Many institutions paid enormous regulatory fines. Senior executives resigned. Banking licenses were revoked. Entire compliance departments were rebuilt from the ground up. Yet the story exposed something much larger than one institution. The greatest financial crimes rarely involve dramatic vault robberies or masked thieves carrying cash. They happen quietly, inside spreadsheets, inside databases, inside perfectly ordinary electronic transfers moving through systems designed to make global commerce as efficient as possible. The ghost bank never needed thousands of branches because its real infrastructure wasn't made of buildings, it was made of trust. Every international bank that accepted a payment instruction became part of a system depending on every other participant to follow the rules. When even one gateway failed, criminals gained access not just to one bank, but to an entire global financial network. Today, regulators are far better equipped to detect complex laundering schemes than they were 20 years ago, but the fundamental challenge remains unchanged. As money moves faster across borders and financial technology becomes increasingly sophisticated, the race between those building stronger safeguards and those searching for new loopholes continues. Because in modern finance, the most dangerous bank isn't always the biggest one. Sometimes it's the one almost nobody notices.
Subscribe if you find these videos interesting. Join Axiom Black as we uncover the stories hidden beneath the surface.